Oculus is a fintech infrastructure for document-driven workflows that empowers lenders with decisionable data. We're really excited. More than 500 professionals have joined us today, and I'm certain we're going to have a lively, very informative discussion. Given the audience size, we have muted the attendee microphones and disabled the chat function to facilitate the attention to the discussion. But you are able to direct any questions about this event or even ideas of future discussions to us at Oculus at marketing@oculus.com, and we'll be reaching out and getting you more information on that. Now, when Oculus discussed this idea a couple weeks ago, bringing together some leading executives in the online lending space, our first call was to Amias Garrity to moderate the discussion. Amias is a partner at QED Investments. He joined QED in 2017, and he focuses on finding new investment opportunities, specifically with back office technologies and infrastructure companies. Prior to QED, Amias served as the president's nominee and as the acting assistant secretary for financial institutions at the U.S. Department of Treasury. And with that introduction, Amias, I'm going to turn the discussion and the introduction of the panelists over to your capable hands.
Great. Thank you, Tim, Sam, Melissa, the whole Oculus team. I'll say that my best role is serving as an investor and advisor to Oculus. You guys are doing well enough to make me look smart, and that's great. So I'm really pleased to be here and pleased to have these great panelists for the discussion. Let me run through introductions first, and then we'll jump right in. So today, we're pleased to have Ido Lustig, the Chief Risk Officer at Bluevine. I think everyone knows Bluevine offers business checking, flexible business lines of credit, invoice factoring. They're a real leader in small business lending. And I remember being on the phone with the CEO of Bluevine just as the PPP program was getting passed through Congress and talking about how they were already gearing up even before the law was passed. So a real fast-moving and great company there, and we're pleased to have Ido join us. Also, Jim Granite. Jim is the SVP of Small Business at Enova, a public company, and he leads all of their small business lending. And also, Jim, one of my favorite members of Jim's that actually I called Jim when I was diligencing Oculus, and he's the reason I made this investment. He was pretty persuasive and told me what a great company Oculus was. Then we have Josh Rogers. Josh leads customer service and operations in OnDeck, and I think we all know OnDeck as the real granddaddy of online small business lenders and a leading company out there. And then finally, David Snitkoff, who is a relatively recent addition to the Oculus family. He's the head of data analytics here at Oculus. We know David going back to his work at Orchard and other QED portfolio companies. So this, for me, is a real walk down memory lane, and I'm glad to have everyone join. So let me start at the biggest picture question here, which is what kind of a recession are we in, and what kind of a recovery are we likely to have? And let me start by attacking that question from the perspective of what have we learned or what can't we learn in light of COVID? If I go back to the two big recessions that I've been living and working in, I think in the dot-com bubble, really learned that shipping, e-commerce, low margin goods like pets.com was trying to was a bad idea. So that's something we learned something about the business, about the economy in the dot-com bust. And I think in the great financial crisis, we learned that house prices wouldn't always rise, among other things. But in COVID, it's not as clear what the business or economic lessons are going to be. So let me start at the 50,000-foot level and just ask each of our panelists, what do you think we're going to learn about our economy in light of this kind of crazy recession we're in? I'll start with Ido. What do you think we're learning?
So I think there are a few interesting learnings that we can take, and I think that there are a few interesting things that we can learn on the economy given COVID crisis. But before I go, it's very important to note, I think, that COVID is unlike anything else we've seen, is a world pandemic that is impacting basically everyone across the board and is shutting down economies completely. It is going to take a very long time for things to recover. So these are unprecedented factors or things that we are now seeing, and it is very important to keep that in mind. With that said, I think that key learnings thus far is if you are not agile, and if you don't use data, and if you are not able to leverage the data to adapt quickly, you will not survive. The world is moving faster and faster with every day that goes by and with every new challenge that the world is facing. Those businesses that were able to use data and use the data wisely to adapt quickly are the ones that are surviving. Businesses that were able to change their business model quickly, restaurants that were able to rely more and more on deliveries rather than foot traffic are the ones that are able to survive. The rest are not. Same goes for companies like ourselves who work with businesses. If we are not able to use data that is available around foot traffic, around cash flow, around government initiatives, around new regulations, if we're not able to leverage new data sources, we will not survive. And if we are, we'll be very successful. And I'm happy to share that we are on the latter rather than the first, which is great.
Jim, what do you think we're learning about how the U.S. economy works in this crisis?
I think this is an incredibly unique situation. Obviously, most forms of recession have a longer time period as they deteriorate, and I think that this was more of kind of a 1 and 0 situation. You had states that literally, kind of came out and said, all right, we're done for now, and everything's shutting down. And businesses went from theoretically 100% of revenue to 0% overnight. So it was one of those where even the best laid plans for companies that were gearing up for an eventual slowdown ended up with a situation where the best laid plans didn't matter as much, and that everyone was kind of instantly affected across the board on a much broader scale. So I think the learnings that we're going to get out of this, are going to be interesting, and I think it's going to be a interesting 2020 hindsight situation as you go backwards and look at it. But I do agree that obviously in the future, using data is going to be more key. I think more people will gravitate to online, practices across the board in all facets of financial services. But I think kind of going back to maybe, what I would like to say, some of the old school of just unit economics, really having good unit economics and being able to ensure that you are, working off of good ROEs or ROIs, and that you're in good shape so you can withstand more of a downturn is going to be really important. It's in what was the best economy, maybe ever for small businesses. If you had stronger UEs at that moment, you're going to be in better shape now. Not that people won't be immune or won't have losses or won't have taken, real big bruises. But you can have a easier time if you were set up to, take a bigger beating, as they would say. So I think that some of the learning will be around how you operate and how you set up for the future and how you think about growth.
Yeah, I think it's so interesting, Jim, that we had a lot of businesses, certainly in the venture-backed ecosystem, that were betting on easy money continuing or venture investors funding non-performance at the unit economic level, hoping for growth. And as you come back, there's going to be a class of lenders who say, well, I'm willing to lend into restart. but you've got to show me that you're going to make money pretty soon thereafter. And I think that's a really interesting challenge for all sorts of small businesses going forward, and frankly, for a lot of lenders. Josh, let me turn over to you, and given your role with customer success, what do you think is going to change or accelerate at the very least in terms of the way small businesses and customers throughout the economy think about their needs? What are they going to see and expect on the other side of this, or will they just be grateful to be in a position where any lender will be dealing with them?
It's a very interesting question. I think, you've got, and I'm sure we'll get to some of this as the conversation continues, but I think what's interesting is, as much as I don't know that there's been a time of need quite as exacerbated as has been over the last sort of month or so. And I think one of the interesting things that we're seeing, and anybody who's been involved with the PPP program, I think will attest to is that the fact is that it has been incredibly difficult for many small business owners to get the attention that they need in what is unarguably their biggest time of need. And so I think that has some very interesting dynamics that is going to present itself in terms of what are their expectations, right, coming out of this in regards to both sort of the digital experience, but also just holistically when you think about sort of an ongoing customer experience and their expectations and how they're serviced, and sort of what comes out of that. And so I think for me, I think unarguably there is going to probably be a continued drive toward increased reliance on digital, right? When you look across the impact that financial institutions and lenders and others who have had that have no digital footprint, it's extremely hard to service customers in an environment where you can't do business or can't have your storefronts open. And so I think, on the financial services end of things, we're going to need to continue to drive toward that digital transformation. And so I think higher reliance on digital will be key. I also think that there will be, I do think there's going to be this underpinning around the totality of the experience beyond just the origination, and particularly in lending, to also into servicing. And I think that's going to be another key, especially in an environment where we're going to be figuring things out for a period of time, right? Coming out of this, because I don't know that there's any historical precedent for any modeling to use directly off the bat, right? I mean, there's going to be an adjustment period. And so how we sort of migrate through that and how we leverage those key sort of customer success, to use your term earlier, indicators, I think is going to be a big thing from my perspective and from where I'm sitting in the world.
Yeah, David, I think this is such an interesting tension because on the one hand, we've heard, and I think it's plainly true, that companies that are not digital, not data-oriented, can't process with automation and with scale are going to be out of luck in serving. And that was a trend that was ongoing, but this certainly accelerates it. And on the other hand, I think we saw in PPP that community banks who were actually willing to just talk to the small business customers that were applying for loans did much better than large banks who were sort of trying to operate with scale and automation, but couldn't even tell a small business where their loan was in the process. David, as you think about the this automation and operating at scale, how do you think about this time of need question? How are you trying to analyze and help all of the Oculus customers that you work with think about, how do we assess need? How do we assess potential for small businesses that have been rocked by this crisis? What are the analytical exercises that you guys have on tap or are working with clients to think through when we analyze this time of need question?
Well, one thing that stands out is that this environment is not a typical recession. In a typical recession, you have some sort of asset bubble and it crashes, and then there's higher unemployment and people have less money. And so there's less consumer spending and less business spending. And so there's a little bit lower economic activity. but generally a lot of things are still correlated with each other. And if you're a lender responding to that, then maybe you stress your models by saying you're going to have 50% more losses, 100% more losses, 150% more losses. But that's generally the band of variability. Here, there's something incredibly different, which is that many of the small businesses that are so vulnerable, they're actually not allowed by the government to do business and to be able to take in money. So it's a very, very different stress exercise if you're a lender to small businesses. And so I think there are two things that come to mind. One is that, to the point about automation and automation at scale, before you automate, you kind of need to know what to automate. It's hard to automate something always out of the gate. So having that combination of humans and computers work together is really, really important. And we've been doing that with a lot of clients. The other thing, and actually along the same line, is that in every business you could think of, and for everyone listening, probably everywhere you ever worked and wherever you currently work, there is some set of processes that are overly manual or overly offline. And whether you work at a bank, a fintech company, whatever it is, and these are processes that have worked well enough. And so people haven't wanted to touch them. Now you have this unique opportunity to actually change them and take them away and automate them, because everything is getting reset anyway. And that, I think, will be a learning from this. But in assessing a small business, the thing that really, really is clear is that so many small businesses operate very, very close to the margin. Pre-COVID even, the average restaurant in the United States had 16 days worth of expenses in terms of cash that they had in their main operating account. That's a very, very thin margin of stress. And so, especially on the smaller end of small business lending, if you're a lender assessing that kind of risk, you can't use typical credit metrics alone. You can't just use whatever you get from a credit bureau. And especially when businesses are very stressed, as they are right now, let's say you have two companies and you have, let's say, one restaurant, and that restaurant owner has paid every bill for the last 10 years, never missed a payment. And you have another restaurant owner, that one has been very spotty, sometimes been overextended, missed a few payments. They're going to have very different credit bureau records. But during a time when so many restaurants are shut down and not even able to operate, what do you actually care about? You care about who can do delivery versus who has dine-in. You care about what of their expenses are variable and what of their expenses are fixed, and how much do they need to spend on rent? How much do they spend on payroll? What ratio of expenses do they have cash in the bank for? And so all these cash flow type metrics become much, much more relevant than the traditional credit metrics that people have used to assess risk for small businesses.
So, Ido, I'd love to hear you respond to David and a similar prompt. I mean, this is a question where you kind of have to throw the model out the window at some level. I mean, nobody used to think, I think, as delivery capability as a prime credit determinant for restaurants. So, Ido, what are you guys doing? How are you thinking about the questions that David is wrestling through on the front lines of how to restart not just government-backed loans, but general purpose business loans?
Yeah, well, I think these are two separate discussion points, right? We can talk about PPP, and I'd be happy to share my thoughts around that. But if you are more interested in talking about resuming lending, then
let's do regular first, and then we'll dive into PPP in the next round.
Fair enough. Okay, so around regular loans, I don't think this is all about throwing the model out the window, because cash flow is cash flow, and negative bank events are negative bank events, and the amount of money you make together with the amount of money you need to spend in order to sustain your business, that doesn't change. So I think that lenders that have access to cash flow data that is accurate, reliable, and in real time or daily refreshed are going to be able to leverage the data very, very successfully. For example, today, these days, when we underwrite at Bluevine, we always ask for month-to-date bank data together with previous months, because what we're doing is we're comparing how you've been operating prior to COVID with how you've been operating recently and very, very recently, last few days. And this is something that we've been doing always, regardless of the crisis. So this is something that lenders are going to continue to rely on. Another example that doesn't actually work, and I think it was already mentioned, is credit bureaus and credit data. The data that we're still seeing is data that is very similar to what we used to see in January and February. In other words, bureau data has not adopted yet and is not reflective as of today, as of now, to the, of course, huge changes that went through the economy. So that's another thing. So long story short, I think it is using your current model, and we are going to we are using our Bluevine score credit model in order to make credit decisions for new and existing clients. But on top of that, you want to enrich that model with more granular bank data, more granular geographical data, which counties, which states, which cities are still in phase 1 versus phase 2 versus advanced phase 2 versus phase 3. What does your website say? We are out of business permanently, we are temporarily closed until COVID is done, we are still working and it's taking us longer, shipments, not shipment, all of these things are things that lenders should leverage and build automation around and build models around in order to more accurately and properly lend going forward. That's my perspective, at least.
And Jim, I think it's fascinating to hear, Ido talk about all the different types of data that they're scraping. At Lendio, you worked with dozens of lenders. Now at Enova, what do you see the industry doing in terms of sucking in and thinking through how to balance and weight the new types of data that Ido just talked about exploring as they work through underwriting models and try to think about the new future?
Yeah, I found it interesting as everyone was just talking. I mean, we started out by talking around automation, right? I mean, that's how we started on this. And then we were just talking about all the different types of data and looking in at, the different websites even, does it say they're out of business? Are they in business? And what's interesting for me, and, I can say my gut reaction to all of getting back into lending is that I think it will be slow, which somebody mentioned earlier. We're not going to rush into anything. There's just a lot to learn right now, and there's too many unknowns to run in and look at things that you can't assess the risk as well. And as a lender, that's our job, is to assess risk, right? And we want to do that well. But when you're talking about all these things that we have to go do, some could be, I'm not going to say are, because we're not there yet, and everyone will do it in their own way, might not be automated. Right, you may go away from automation for a while to get your sea legs back, to have to look at things that we may not have looked at in the future, or shift your thought process around whether it's cash flow or industry or duration or loan amounts or your algorithm changes or your risk appetites or the type of customers that you look at, or gaining that real-time bank data may be more important, and other things like month-to-dates. And everyone is going to have their own version of what works for them, which is why there are a lot of lenders doing a lot of different things and a lot of different loan types that have been around from, when I worked at Lendio, and we had many, many lenders that were very good lenders that are on a platform fitting different needs. And, and to today at Enova, where we as a direct lender, we have a different risk appetite in the way that we look at underwriting and the way we look at customer experience and the output around unit economics. And I just think that a lot of these things are going to be ongoing and changing, because the one thing that I think I've learned during the last 10 weeks or so is whatever works today may not work tomorrow. And I think I got to take it slow and thoughtful and not rush into anything that we go do, but I think it's going to be a slow trial and error back to whatever the new norm will be.
And Jim, we just had a great question from one of the participants asking about, we talked about that from an underwriting perspective. What about from a portfolio performance perspective? What are you learning about portfolio performance? I would imagine that at least in some measure, portfolio performance has overperformed expectations from early March because of the size of the stimulus and PPP loans and things like that. But what are you seeing, and how are you starting to work your way into portfolio forecasting, not just underwriting?
Yeah, that's a great question. And again, I think each company has probably an individual thought process and strategy toward what they're trying to do toward portfolio management. At Enova, I think we were, as our CEO talked about on his last conference call, I think we were one of the first companies to stop lending in this space because of the risk assessment that we thought was out there. It was tough to underwrite and assess the risk. Not that we could or couldn't per se, but if you can't do it on mass scale, you have to start to say to yourself, hey, am I doing something that's beneficial to all parties, including customers? You don't want to put customers in a bad position, and you don't want to put you or your shareholders or your company in a bad position. So, we took an approach where we were, I think, early to the game and of saying, hey, we need to start looking at our portfolio. And in our portfolio, we tried to start to right size, the companies that were going to be more affected versus less affected. Obviously, restaurants, bars, things like that, like anybody on this panel will say, they spent, I'm sure, some good amount of time going through a risk assessment of industry, of geographic, and other things. And we spent time doing that along with cash flow analysis, and then tried to come up with good operating and customer engagement practices to try to maximize the customer experience along with maximizing dollars collected. And there's a balance there, and everyone's balance is their own. For some companies, they may lean more toward customer engagement and less toward dollars collected in a short term. Others may want to go heavier on, I want my dollars back now, and we'll figure out customer experience in the long run. That's for everyone to figure out. So what we try to do is find a appropriate balance that we thought maximized our ability to get both of those in the customer experience as well as get dollars collected so we can service customers for a long time ongoing.
Let's dive into PPP, and I want to start with the present moment. So it now appears that the pace of new PPP loans has slowed sufficiently that it's not even clear that we'll exhaust the second tranche. And I think there's a lot of different potential explanations. One, sort of the most optimistic potential explanation is, we've satisfied everyone who needs a PPP loan. I happen to think that's unlikely to be the case. What are you guys seeing out there? And Josh, maybe start with you in terms of new small business lending or small business interest. What are you seeing? Why is this slower now? And what are the prospects for that being an optimistic case that we really are scratching the itch of small businesses across the country?
Yeah, so I'll start by saying I probably do not hold the view that we have satisfied the need. I think it is probably much more so a question of the design of the program and sort of the implications that it had. I think, what the government did very well is I think they responded very quickly, right? So unlike what you saw in the financial crisis where it took months to sort of like get to a sort of any action, they took action very quickly. But I think with that action, you ended up in a scenario where there's a lot of unknowns, right? I think anybody on this call can sort of probably attest to the fact that sort of the daily sort of adjustments to new guidance coming out around this PPP program made it very confusing. And for those of us who are in a lending space, who are dealing with this on a regular basis, if we're having a hard time sort of maintaining and keeping up with the pace of those changes. You can imagine for, sort of the normal like small business owner who is trying to manage their business on top of deal with this crisis, like the amount of sort of uncertainty. And I think the lack of certainty around, hey, what can I use the money for? The lack of certainty around, hey, how much of this is going to be forgiven, all sort of creates this environment. And if we take sort of this example of the restaurant, for example, like if I'm not serving and maybe I do carry out, but I probably don't need my full staff. So if I don't need my full staff, what good does a PPP loan do for me? Because my payroll expense is not going to be 75% of what it was previously. And if that's the case, now I'm just sort of taking on some incremental debt at, for 18 months at 1%. Yeah, that's great. But if I don't know sort of what the impact that's going to be, nor the process through which that's going to be forgiven, it creates a lot of unknown. So I think that more likely what you have is, I think there's probably, it's my personal belief that I think there's probably a pocket, there's probably a pretty big pocket of small businesses out there that are still waiting. And I think that, as we continue to move forward here, as states and geographies begin to reopen, you may start to see some businesses and you may see that pace pick up again. But I think this is more an indication of the structure of the program than it is of sort of the existing need.
Yeah, I mean, I'll just observe, and I think people generally know my background at the government. I started in the height of the financial crisis at Treasury. One of the understandable, but I think regrettable choices is that they started the program before they had licensed a group of fintech lenders. And because of that, fintech lenders as a whole basically were not able to make any loans in the first tranche of the program. And I think that resulted in a really uneven distribution where the smallest, most vulnerable businesses were shut out in the first. And by the time we got to where we are now, a lot of that uncertainty has kind of settled in. So I think it's an understandable choice because they wanted to move fast. But I think in retrospect, they probably would have been better off even just waiting 3 or 4 days and getting a cohort of non-bank and fintech lenders on board so that the first distribution could have been more even. David, you sit at Ocrolus. You guys see a lot of volume. Some is PPP, some is people still lending, merchant cash advance, other invoice factoring. What are you thinking? What are you seeing looking across the sweep of your customers for where the demand is, where the supply is over the next 6 to 8 weeks, and whether PPP is going to be enough to power us through into a restart of small business lending and small business activity?
So I think where you continue to see supply of credit is where lenders have capital that's not dependent on capital market sources like securitization and credit facilities and things like that. I think those markets are very stressed right now. Lenders who have different types of capital, they're still not doing as much lending, aside from government lending, of course, but some have been able to keep their doors open a little bit for the customers that they still want to underwrite. I think, to echo what Josh was saying, PPP in its existing form is probably not enough to get us back, not because of the amount of money, which is very large, but just because of the structure of the program. Depending on what type of business you are, you may need different types of capital in different forms with different restrictions or lesser restrictions, given what you need. And Josh's restaurant example was a good one, and you can think of so many more. So whether that comes in the form of, other government direct lending programs or individual lending companies being able to get, back up and running quickly with new types of products that are relevant for their customers, that's, I think, what'll get us to the other side of this. And the thing that we haven't talked about too much yet is just the capital markets impact. So where, other than the government, where the lenders themselves get their money, because of course the little people, the small businesses are very stressed by this, but of course that bubbles all the way up to the capital markets. And so if you're pretty much any non-bank lender, you're dependent on those markets for liquidity, and you have credit facilities and securitizations that you use to fund your originations, and those have certain eligibility requirements and covenants and concentration limits. And when a situation like this throws your portfolio out of whack, suddenly those deals start to have issues, and you also have to pay a lot of attention to keeping liquidity there. So I think the liquidity side is very, very interesting. And then the last point I would make on that, still on liquidity, is if you look at the stats that the Fed put out for the PPP liquidity facility that they made available, it was very interesting and actually heartening to see that some of the biggest users of that facility in terms of banks were the types of banks that support fintech lending, whether it's Celtic or Cross River or WebBank or Radius. They were right up there, and in many cases ahead of other banks that had used the PPP liquidity facility.
So I'd love to do a little bit of a lightning round. Now we're about 40 minutes in, so we're pretty warmed up. So let's do a series of kind of yes, more or less, pretty much the same lightning round. So let's start with the let's take Q4 of this year and say non-government backed lending will be more than February 2020, less than February 2020, or about the same back to where February 2020 was. Who's up for it'll be more? Who thinks it'll be a lot less?
Definitely less. For Q4?
Yeah. I mean, as an industry,
I think it's less.
As an industry, I think it'll be less.
So
I think there may be individual lenders who are able to ride a wave and increase, but in aggregate, I don't see it not being less in aggregate.
Yeah. I think those who have money to lend, like large banks, are going to be very, very careful and as they've always been, right? And even more so. So it'll take them more time. This is one. Two, I think people are expecting a second wave of COVID, and they worry that those businesses that were able to survive because they were smart and because they had slightly deeper pockets are not going to survive the second wave. So that's two. And three, others rely on capital markets that are struggling as well. So I don't know if fintech lenders are going to be able to scale up as quickly as possible. With that said, at least at Bluevine, we are looking to, and we've already started, re-lending, and we're going to do this very slowly and very carefully and very hopefully wisely, right? That's up to us. But definitely the answer is less.
Yeah.
If you ask me.
Bank and fintech partnerships around small business lending. We've seen positive signals and negative signals heading into COVID. Seems like some positive signals per Ido's original comments around data and nimbleness. So, second half of 2020, will we see an acceleration in bank and fintech partnerships?
Yes,
I think there's a good chance we will, and it's always hard to predict partnerships because so many partnerships, they get announced but they don't materialize or they don't succeed. But there's a good chance, and the reason why I think there is because there's such a good reason, excuse is the wrong word, but in the internal politics of a bank, to get something started and to partner with a fintech takes, a lot of approvals, a lot of diligence, a lot of auditing. And now is kind of a time where, a fintech company that's thoughtful and persistent can actually get something through because of the urgency there. And every bank should now recognize, and I think they do recognize, the need to be nimble, be automated, do things in the cloud, have more online customer acquisition. And so the door is very much open for those types of partnerships if they can be well executed.
Yeah. Josh, you've obviously been on this roller coaster with OnDeck. Without asking specifically about your partnerships, what can you tell others about the promise and the perils of bank partnerships with small business lending?
No, look, I do think that there will be a continued focus on partnerships and maybe even a renewed sense of focus on partnerships from some banks. I think I think what this has taught us is that we have transformed certain aspects of the lending experience into a digital environment. But there are still a whole host of financial institutions out there that have next to zero digital presence when it comes to origination. And I think because of that, my guess is that what we will begin to see is a raising of the bar, right? So the consumer expectations or merchant expectations around what are table stakes for them coming into this will likely begin to include aspects of a digital experience that they didn't previously have an expectation of. I think, what we hear a lot about small business owners is that it's very relational, it's very network driven, it's a very sort of close, sort of intimate network that they maintain and that they rely on. But I think what is going to be interesting coming out of this is how does an environment where an institution that they thought that they had a relationship with, that they relied on, didn't meet the need, and what does that do from a consumer behavior perspective, and sort of how does that change their decision making? And so I think you may begin to see more self-service driven small business owners, or what we would consider to be digital assisted experiences with a banker that will by nature force an environment for partnership, because I don't think that the dollars are going to be there from an investment perspective for everybody to go out and just build this on their own.
Yeah, I couldn't agree more with Josh. And I think that, at least to our experience, we are getting dozens of our new PPP customers reaching out to us saying, I've had it with my bank. I love the experience that you guys gave us. I love the speed. I love the service. I love the fact that there was always someone to talk to, but at the same time that you were so quick, et cetera, et cetera. I want to do business checking accounts with you. I want to move. I want to quit my bank. So definitely there is a desire, and I think the customers or business owners got used to much better service and much better support these times. That said, I think that banks are still struggling, large banks for sure, with their internal processes. And even though this is the time for them to be working with fintech companies, to my experience and what we've seen is it is still much easier for us to work with the cross-river banks and satellite banks of the world than working with larger ones, because they're simply too slow. So I think either larger banks will adapt and shift gears, and then we'll see more collaboration in Q4 or next year, or they will struggle and they will start struggling. And I look forward to seeing how that evolves.
You raise a really interesting dynamic between banks and fintech lenders. So one version of the story that may have started and really accelerated in COVID is what I would call a product expansion story. So, hey, this digital experience and the companies that brought me speed, responsiveness in a time of crisis, I want to have a checking account with you. I want to have more of you. I want to expand my product with Bluevine, as you just alluded to. And then another version would be, hey, boy, the banks are the safe harbor. If only you guys could get digital, I would be with you forever, because those fintech guys, couldn't even get funded in the first round of PPP. Right? There's two very different stories. Which story does this panel think is going to dominate if we look forward 3 years? Is it going to be old line banks getting digital, or is it going to be fintechs with really broader product suites that can be full service?
I think it's a little bit of a both, and not to dodge the question, but I'm going to explain what I mean by that. I think the bank versus fintech distinction is almost something that we all care about because we live in this world. From a customer perspective, if you're a small business owner, you want access to capital on the right terms at the right price quickly. You want good customer service. You want a checking account that meets your needs. You want a credit card that works for you. You want a debit card that works for you. You want merchant services that work for you and have decent fees and good service if anything goes wrong. If a bank were to offer that, people will take it. If a fintech company offers that, people will take it. I think what people want is, personalized financial services that meet their needs, regardless of who will provide them. Fintech companies certainly have an advantage in being nimble enough to do that, but that's not to say that certain forward-thinking banks won't also be able to do the same thing.
Yeah, it's a great, it's kind of a job to be done framework, David. So let me turn that to the three lenders on the panel. My assumption is that you guys don't traditionally think of yourselves as employing a bunch of loan officers who, in the traditional mold, who work with individual small businesses to give them the personalized services that they need, or individual bankers in the old, potentially mythological version of the story. Given what you're seeing from your customers in this time of need, how are you guys thinking about that? The potentially to have that warm voice to talk to, the knowledgeable counterpart, in addition to automation and scalable cloud-based services.
Let me give you my personal example, right? And as everyone can say or tell, I wasn't born here, and I actually moved to the US with my family a couple of years ago. And I've been working as a consumer with one of the largest banks. I have my checking account there, and I'm very happy. And I never talk to anyone, and I use all their digital services and all their automated services, and it's been working great for me. And I don't need a branch. I personally don't need someone to talk to. I think on the small business front, I think this is definitely not the case, and I think banks are way years behind the level of service that they provide consumers and enterprise companies in comparison to what they provide small business owners. And I think that sucks. And I do believe that only through automation, machine learning, and scale can fintech lenders provide the services to the level that small business owners need, which will allow them to be the ones that speak to business owners, that are there to answer the phone when business owners need, that are there to answer the email when business owner need, because they have scale, because they have automation. So they can, these fintech lenders, and this is what we try to do at Bluevine, have the ability to actually support their customers, support business owners, because they have automation to enable services to a very, very large audience with no human interaction. So those humans who are there to interact with small business owners will be able to do so very easily with the ones that need. And I hope that was clear.
I think that's a really good point. I think that what I don't want to lose sight of is I think that the automation and the technology certainly assist, right? And they certainly need to be there to drive the opportunity for engagement, because I think what we are seeing is that people want to be seen, people want to be known, right? There's no question about that. And just to build on Ido's example, like I partner with a large credit union on the personal side, and my wife and I moved to Colorado about 6 years ago. There's no presence out here. I've never needed to talk to anybody. I can always go online. That being said, my wife's car was broken into, her purse was stolen, her checkbook was stolen, and all of a sudden I had to close all my accounts. I had to reopen new accounts. I had to get brand new debit cards. We had zero ability in terms of any of our traditional sort of cards, checks, cash, anything that we could do for a series of about 10 days. And I'll tell you what, in that moment, partnering with a small credit union that knew me, that cared about me, meant way more to me than it did at a time for the other days. And so I think that the key is that how do we, and as Ido sort of mentions, like how do we leverage technology to build on and create opportunities so that when there are meaningful interactions that need to occur, we're there to maximize that every single one of those individual interactions.
Yeah, I would say actually, I totally echo what the last two gentlemen said in a lot of ways. And when at the time when we were looking at Lendio and building out the concept of what we did at Lendio, we went through, there were a lot of people in the space that were screaming automation, 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 right? Both that were marketplaces, lenders, and this going back 5, 6, 7 years ago. And a lot of people that try to do 100% automation have either struggled or changed their operations, right? They went from saying, I'm never going to have a sales floor, to they have sales floors. Or I'm going to have all automation and we're going to only underwrite that way, to where they underwrite maybe a part of their book that way, but not the other part of their book that way. And what we tried to do there, which I think flows into what we've tried to do at Innova as well, is provide people that want automation or want touchless or frictionless opportunities or customer experiences. You do that where it's appropriate. And there's other areas of the experience or people that want to actually talk to somebody and go through that, and you want to provide that customer service. You need to be able to do both of those, where you can build out scale and so you can have obviously create lifetime value and create a great customer experience where they want to come back and use your services over and over again, or expand into services. And at the same time, you want to be able to do it where you can reach out and touch somebody if needed, because certain people just like to understand and talk to somebody before they make a decision of what could be hundreds of thousands of dollars and or affect their livelihood and their family's livelihood and their employees' livelihoods. And I think that that healthy balance and allowing for both in a way that's scalable is critical, and will be critical going forward for banks, on your other question of how they look at it. So I don't think it's an and or. I think it's going to be you need to do that to stay in the market, whether you're a big bank and you buy, partner, or build. And if you are a fintech, of how you buy, partner, or build will be the same. It will just be that will be kind of the gold standard of the way to do it. I think you're going to have to be able to do both on some level.
All right, so we're going to fire up our final question with a version of the Peter Thiel interview question. What do you believe that others don't? So, putting David as on the spot first, because he's got home court advantage. David, give us something that you think will happen in the next 12 months to 18 months in small business lending that others think is crazy.
You know, I have so many good answers to this question that don't have to do with fintech. So, okay, what's going to happen with small business lending in the next 12 to 18 months that other people might think is crazy? So I think maybe this is not so crazy, but I do think small businesses will begin to seek credit from companies that have traditionally not been issuers of credit, but have some other kind of customer relationship with them. And you can already see that happening somewhat around the margins today, although it's not a huge trend dollar-wise. I think you're going to see that accelerate significantly, for a few reasons. One, because a lot of the lenders who already have large portfolios, depending on how they've structured them, they may have that overhang of a portfolio that's been through this period of time, which may slow them coming out into a recovery, and someone may come in and fill the gap. And also companies that have a non-lending but interesting operational relationship with small businesses may have proprietary data that they could use to assess these small businesses in a novel and advantageous way. So I think there is it's not a totally new, totally crazy thing, but I think it's a possible interesting thing that we may see develop.
All right, who's brave enough to go next?
I think as far as online lending goes, I think that we are going to see some companies fail, and we are going to see some consolidation. And maybe within 18 months, if the economy is back, we will see some large winners, big winners, as a result of what I just said. And I look forward to seeing how that would evolve.
Yeah, I think to build on that, I think the other interesting thing will be sort of combining sort of the last two comments will be to see, I think there will be consolidation, but I also think that there will be new entrants. And as those new entrants come in and maybe aren't burdened by portfolios that historical portfolio performance and other factors that maybe other lenders have, how they're able to gain market share sort of in that environment.
Jim, you've got the last word.
I got the last word. I'll go contrarian to all those. I think a lot of the people that think the landscape is going to dramatically change, that maybe it doesn't.
The status quo is a contrarian view. I love it, Jim.
I don't know. Maybe. Who knows?
All right. Well, I want to thank Ocrolus, thank the panelists. This has been a great conversation. Tim, what next for all those who have taken an hour of their time to listen to us ramble?
Thank you so much, Amias. I will say, for me, that was FinTech's fastest 60 minutes. So I really enjoyed that conversation, and I'm sure our audience did as well. My thanks also to Jim, Josh, Ido, and David for sharing your insights. And I want to apologize. I know we had some technical challenges with audio and video for some of the attendees. We were hitting capacity on our Zoom platform, so I apologize for that. We will be sharing this roundtable with everyone, so you'll get an email with a link to that recording, and we welcome your feedback. This is the first virtual roundtable we did on small business lending, and given the response, it's definitely not going to be the last. So again, my thanks to our panelists, and thanks to everybody for attending.